Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at ServiceNow.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you trade stocks, crypto, forex, gold, or indices and want clearer buy and sell signals, you can check out VIP indicators through my link below. Grow $100 to $10K with VIP indicators. VIP Indicators offers TradingView indicators, market alerts, trading education, and chart reading support with up to a 93% win rate. The tools are designed to help traders spot possible setups faster and trade with more confidence. But please remember, trading is risky. No indicator can guarantee profits, and growing $100 into $10K is not guaranteed. Use these tools for education and analysis only, manage your risk carefully, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
So, if you're looking at your portfolio right now, particularly your tech allocations, you're probably feeling all that anxiety around the SaaS apocalypse.
Oh, definitely. It's everywhere right now.
Right. There's this pervasive underlying fear that artificial intelligence is just going to come in and completely wipe out traditional software as a service companies.
Yeah, the idea that AI agents will just do the work so you don't need the software anymore.
Exactly. But then you look at a business like ServiceNow, and they are just aggressively pushing back against that entire narrative. They're trying to position themselves not as, a victim of AI, but as the actual AI control tower for the enterprise.
Which is a completely different way to look at it. And that's exactly the tension we need to unpack today, because the central mystery here is this massive disconnect between their execution and their market valuation.
Yeah, it's glaring.
I mean, on one hand, you have a company that is fundamentally putting up just incredible numbers, but on the other hand, the stock has suffered a severe 40% drop from its recent highs.
40%, that's not a small correction.
Not at all. So as an investor, you're looking at a business that's arguably operating better than it ever has, yet the broader market is, pricing it like a legacy company in secular decline.
Yeah, and when you're trying to figure out if a 40% drop is a warning sign or like a generational opportunity, you really have to look at the economic mode. All right, let's move into the wealth building context.
Right. So to really understand this from a long-term wealth perspective, we have to talk about the concept of a halo stock.
A halo stock.
Yeah. In the current market environment, smart institutional money is basically hunting for systems that AI absolutely cannot replace. A halo stock sits completely insulated from that displacement risk.
Got it. So they're protected from the blast radius.
Exactly. And ServiceNow fits this perfectly because it acts as the absolute central nervous system for a company's operations. We're talking about the underlying infrastructure for their IT ticketing, their HR onboarding, security patch protocols.
Customer service routing, all that.
All of it. It functions as an irreplaceable system of record.
Okay, but let me play the cautious skeptic here for a second.
Sure.
A 98% gross retention rate is undeniably great. I'm not arguing that at all. But, software is moving faster right now than it has in 20 years.
Oh, absolutely. Entire paradigms are shifting overnight.
Right. So are they just a sticky legacy system that IT departments are simply too exhausted to replace? Or are they actually growing wealth? Because just being sticky isn't the same as being a compounding growth engine.
That is a completely fair question, but this isn't just inertia from tired IT departments. They are what we call a rule of 60-plus compounder.
Okay, let's break that down for people who might not track that specific metric.
Yeah, so it's basically the gold standard for software efficiency. If you add their revenue growth percentage and their free cash flow margin percentage together, it's top 60.
Wow. Over 60 is elite territory.
It really is. And the reason they maintain that 98% retention isn't just because replacing them would be a multi-year operational nightmare. Though, let's be real, tying up your payroll and security in a transition absolutely is a nightmare.
Oh, nobody wants to do that.
Right. But it's actually because they're actively evolving to become the neutral orchestration layer. By connecting multiple different AI stacks and disparate cloud environments, they prevent vendor lock-in for their clients.
So they're the bridge.
Exactly. They're the bridge between the old way of working and the new AI models. You don't burn the bridge when the technology on either side of it is changing so rapidly. You actually rely on it more.
That makes a lot of sense. So the switching cost isn't just about the headache of buying new software. It's about fundamentally risking the day-to-day operations of your entire business.
Completely.
When you realize how deeply entrenched they are, it really reframes how we should look at their financial ceiling. Now let's look at the fundamentals.
Let's break down the massive Q1 2026 numbers, because this is where the whole SaaSpocalypse narrative really starts to fall apart. They reported total revenue of $3.77 billion.
$3.77 billion in a single quarter.
Yes. And within that, subscription revenue was up 22% year over year, hitting $3.671 billion.
See, when you think about the law of large numbers, maintaining a 22% growth rate at a multi-billion-dollar scale is, it's exceptionally difficult.
It is. They're actually moving so fast that they are on track to beat their 2026 subscription target of $15 billion by $500 million.
Wait, and that's entirely organically?
Entirely organically.
That's wild, because in a macro environment where many enterprise software companies are just, trying to maintain their existing guidance, pulling ahead organically by $500 million is huge. You have to ask yourself, how exactly are they pulling that off when IT budgets are supposedly shrinking?
It all comes down to their 2030 vision and how they're monetizing their new products. Management recently guided for over $30 billion in subscription revenue by 2030.
30?
Yeah, if you map that out, it implies a compounded annual growth rate of roughly 19 to 20% over the next 4 years.
And a massive driver of this has to be their AI segment, right? The Now Assist stuff.
Exactly. The annualized contract value, or ACV, for their AI segment already crossed $750 million in the first quarter, and they are targeting $1.5 billion for the full year of 2026.
See, I want to bring in the practical financial health side of this, though, because top-line growth is a great headline, but forward visibility is what actually lets you sleep at night.
Oh, absolutely.
They currently have $27.7 billion in remaining performance obligations, or RPO.
That number is just staggering.
It is. That's essentially contracted future revenue that just hasn't been recognized on the income statement yet. Having almost $28 billion locked in, which is nearly double their current annual revenue, it provides this baseline of stability that most tech companies would kill for.
Plus, you have to look at the profitability metrics. Their operating margins are sitting at 32%, and their free cash flow margin is at 44%. But the mechanism behind these margins is what I find most compelling. They are literally drinking their own AI champagne.
What do you mean by that?
By deploying their own automation tools internally, they're fundamentally changing their cost structure. They're using AI to automate routine level 1 IT support internally, handle basic HR onboarding steps, and resolve software queries without human intervention.
Ah, so they're their own best case study.
Precisely. By doing this, they're projecting $100 million in operational expense savings for 2025 and another $200 million in incremental savings in 2026.
That goes straight to the bottom line.
Exactly. And the kicker. They're doing all of this while keeping their overall headcount completely flat.
I do have to push back on the AI narrative a bit, though, because let's be honest, every single software company in the world is slapping an AI label on their product right now to juice their valuation.
Oh, for sure. It's the buzzword of the decade.
Right. So how is their Now Assist any different from a company just buying an enterprise API key and plugging into a generic large language model like OpenAI? Why shouldn't a Fortune 500 enterprise just build a direct connection to a foundational model and bypass ServiceNow entirely?
That is the exact question every chief information officer is asking right now. And it comes down to what ServiceNow calls the context engine.
It's context engine, okay.
Yeah, think of it this way. A generic large language model is like having a massive dictionary. It knows all the vocabulary in the world.
Right.
But if you tell a generic AI to process an HR claim, it doesn't know who at your specific company needs to approve it, what internal budget code it hits, or what compliance rules apply to your specific geographic location.
Because it doesn't have the company's specific operating blueprint.
Exactly. ServiceNow is the grammar rulebook that structures that dictionary into actual business actions. They have 22 years of proprietary enterprise workflow data.
Wow, 22 years.
Yeah. It knows exactly how your company runs, who reports to who, and exactly what business logic applies to every single action. That context is what grounds the AI in reality so it doesn't hallucinate a catastrophic mistake.
That's a huge distinction. Knowing the vocabulary versus knowing the exact operational rules of the house, tracking how quickly enterprise clients are actually buying into that reality is crucial. That brings us to the Catalyst timeline.
We have some very specific binary events to watch over the next few months. First up is the Q2 2026 earnings report coming in late July.
Oh, everyone's going to be watching that.
The entire market is going to be laser focused on one metric: Are they tracking to hit that raised $1.5 billion AI run rate target?
And beyond just the quarterly numbers, the product momentum following their recent Analyst Day it's aggressive. They unveiled Project Arc, which is a major collaboration with NVIDIA.
Huge partnership.
Yeah. And they announced the Auto-Unified AI Experience and introduced their autonomous workforce platform. These aren't just minor feature updates. These are foundational shifts aimed at letting enterprises deploy AI agents directly into their workflows.
But here is where the timeline gets really fascinating. There is a highly compelling, albeit speculative, rumor that leaked out of that same Analyst Day.
Oh, I know what you're going to say.
CEO Bill McDermott reportedly previewed a total satisfaction guarantee on AI go-lives in less than 100 days.
Okay, we need to pause there because a 100-day guarantee in enterprise software is practically unheard of.
It really is.
If you've ever been part of a massive software migration, they usually take quarters, if not years, and they're notoriously buggy and prone to delays. Offering a hard guarantee like that is inherently risky for ServiceNow.
Very risky.
If they fail, the financial penalties and reputational damage could be severe. However, if this is formally announced, think about what it does for the customer. It massively de-risks AI adoption.
Which is the biggest hurdle right now.
Exactly. If you're a CIO, you are terrified of betting your career on a failed multi-million-dollar AI rollout. A 100-day guarantee completely removes that hesitation. If they can actually deliver on it, that could significantly accelerate deal closures in the second half of 2026.
Hearing all that incredible execution and future certainty really makes the current stock price look incredibly disjointed. Now let's pivot to the chart.
We absolutely have to address the elephant in the room here. We just spent all this time outlining flawless fundamental execution, yet the stock is down 40% from its highs.
Yeah, it's currently trading in the $91 to $94 range.
It is actively trying to rebuild a heavily damaged trend line.
The valuation right now is just fascinating because it's priced like a legacy hardware company about to be disrupted, not a high-margin software giant growing top line at 22%.
Where's the multiple setting?
It is trading at just 21 to 22 times forward earnings. For a rule of 60-plus compounder, that is a multi-year low. The premium multiple that this stock has historically enjoyed has been completely washed out by the broader market's AI fears.
Which makes the technical setup quite tense. There are early signs of a positive reversal attempting to form. We saw shares surge 5.45% in a single session right after the Analyst Day.
Yeah, that was a solid bounce.
It shows that at least some smart money is starting to digest this AI growth strategy. The immediate technical target for a bullish confirmation would be reclaiming the $104.50 area. If it can break and hold above that level, it returns to the 50-day moving average and potentially snaps the broader bearish trend.
With the chart looking like a battleground between past premium and current reality.
So what does market sentiment look like?
It is a genuine institutional tug-of-war right now.
It really is. I mean, on the bearish side of the sentiment ledger, you have a notable indicator from Tiger Global Management.
Ah, yes, the 13F filings.
Yeah, in their recent filings, they decreased their stake from over 2.1 million shares down to 1.5 million shares. When you see a major player trimming that heavily, it looks a lot like institutional profit-taking, or at least a conscious de-risking away from premium software valuations across the board.
That is true, but you have to counter that institutional trimming by looking at corporate confidence. While some funds might be reducing exposure, the company itself is aggressively stepping in to buy its own stock.
They're backing themselves.
Big time. They executed a massive $2 billion accelerated share repurchase, or ASR, in the first quarter alone. Furthermore, they've announced they're explicitly doubling repurchases for 2025 to offset any stock-based compensation dilution.
That's a massive signal.
It is. When a management team is buying back stock at multi-year low valuations with billions in cash, it signals a very strong internal conviction that the market has mispriced their asset.
And the mood on Wall Street seems to line much more with management than with the sellers. Analysts have been steadily raising their price targets throughout May 2026.
Yeah, let's run through those. Barclays raised their target to $134.
Okay.
Evercore ISI bumped theirs to $150. D.A. Davidson is maintaining a $190 target. And Bernstein is incredibly bullish, going all the way up to $236.
We are also seeing some broader macro tailwinds develop that support those higher targets. The software sector as a whole is starting to show signs of a turnaround after a brutal re-rating.
Yeah, we've seen similar technical recoveries in other legacy tech giants recently, like Cisco.
Right, which technicians have pointed to as a prime example of what this market is capable of when institutional money finally rotates back into high-quality cash-generating names.
Of course, those sky-high price targets assume the legacy software model actually survives the decade.
Exactly. Now let's talk about the risks, because there is a very valid reason institutions are getting skittish.
Despite the bullish targets, the bear case here is incredibly serious, structural, and needs to be unpacked carefully.
The ultimate threat is AI SaaS displacement. We've talked about the SaaS apocalypse. Let's look at what happens when AI native deployment vehicles, like the new Anthropic Blackstone firm, or OpenAI's new DeployCo start aggressively trying to completely disintermediate workflow middleware.
Right, bypassing the traditional platforms entirely.
The entire traditional software model is based on human seats. You sell a license for every single employee that needs access to the system. But if an enterprise deploys an AI agent that suddenly replaces the manual work of 5 human employees, what happens to the software provider?
Do those 5 per seat licenses just evaporate?
Exactly. That structural risk to top-line revenue is exactly what has institutions so nervous.
It is a massive existential risk for the legacy software industry at large. But this is where ServiceNow's mitigation strategy is genuinely fascinating. They aren't trying to fight the wave of AI efficiency or pretend it isn't happening. They are fundamentally pivoting their business model to capture it.
Also,
Currently, 50% of their net new annual contract value is now completely non-seat based. They were transitioning to usage or token-based pricing.
wait, I need to stop you there and really clarify this, because management teams always promise that new pricing models will offset lost licenses, but it rarely works perfectly.
Their point.
If an enterprise deploys an AI agent that successfully does the work of 5 humans, ServiceNow does indeed lose those 5 traditional, highly lucrative seat licenses. That's immediate guaranteed revenue gone. I'm saying that the back-end compute usage actually offsets that entirely, or is management just hoping it does?
It's not just hope, it's the underlying mechanics of how AI operates. Yes, they might lose the flat fee from those 5 static human seats, but think about it. A human only clicks so many buttons in an 8-hour shift.
Right, maybe a few hundred actions a day.
Exactly. An AI agent doesn't sleep. It moves exponentially faster. It constantly queries back-end databases. It cross-references thousands of files, and it generates a 5x increase in back-end compute and system actions.
Ah, so the volume explodes.
Yes. Because ServiceNow is charging for that underlying usage, the sheer volume of tokens required to make the AI function, the AI efficiency threat, actually transforms into a revenue expansion flywheel.
That is brilliant.
An AI doing the work of 5 humans requires vastly more system queries than those humans ever did. They aren't fighting the undertow of AI displacement. They are actively monetizing the sheer volume of data it requires.
When you map out that transition from selling static human-bound seats to selling dynamic machine-driven usage, it changes the entire narrative of their future. So with everything on the table, what's the final verdict?
When you synthesize the flawless fundamental execution, the transition to usage-based pricing, and the drastically compressed technical valuation, the picture becomes quite clear.
Based on our research metrics, this comes in with a bullish score of 8 out of 10. The underlying business is proving its resilience, its deep moat, and its adaptability in real time.
Looking at a multi-year horizon, roughly 1 to 3 years out, this represents a highly unusual entry point. It is rare to find a rule of 60-plus compounder trading at this kind of multiple compression. They are decisively on track for their $30 billion subscription target by 2030. They have proven they aren't going to be a casualty of the AI revolution. They are the definitive halo stock orchestrating it. The AI control tower stands strong.
And if you want extra help reading trading charts, you can check out VIP indicators through the link below. The campaign is Grow $100 to $10K with VIP indicators, and their tools include TradingView indicators, market alerts, and trading education with up to a 93% win rate. But trading always carries risk, and no profits are guaranteed. Use the tools for education and analysis, manage your risk carefully, and always do your own research before making any trade. This is an affiliate link, and I may earn a commission and no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.